There's a line at the bottom of the checkout page. You've seen it. Maybe you've clicked it. Or 4 interest-free payments of $20. And something quiet happens in your head when you read that. You don't think, I'm about to borrow $80. You think, oh, the one, 20. You didn't feel like you were borrowing. You felt like you were being smart. That 1 second, the second where $80 turns into 20, is the most valuable second in modern retail. Entire companies are built on it. Today I'm going to show you exactly how that second gets manufactured, who pays for it, and what it actually costs you. Because here's the thing that makes this worth your time. Buy now, pay later mostly doesn't charge you interest. That's not marketing spin. That's true. So if they're not making money from your interest, where is the money coming from? Somebody is paying. It's worth knowing who. Let's start with where this stuff has ended up. LendingTree surveys Americans about buy now, pay later every year. The most recent one, conducted in March of 2026 with over 2,000 adults, found something that should stop you. 29% of buy now, pay later users have used it to buy groceries. 2 years ago, that number was 14%. It doubled. And among Gen Z users, it's 38%. Groceries are their second most common use of it, behind only clothes. Now, the easy move here is to make fun of that. Don't. The same survey found that 54% of users say they couldn't make ends meet without it. Among parents with kids under 18, it's 62%. That's not a story about people being irresponsible. That's a story about a tool that showed up exactly where the pressure already was. But the number that matters most isn't 29%. It's this one. 47% of users have paid late in the past year. In 2025, that was 41%. In 2024, 34%. It has climbed 2 years running. So hold those two facts next to each other. It's spreading to groceries, and more people are missing payments. Keep both in your head, because by the end of this, you're going to see they're the same fact. Okay, back to the question. If they're not charging you interest, who is paying? The merchant is. When a store offers you buy now, pay later at the checkout, the store pays a fee on that sale. Klarna's merchant rate runs roughly 3.3 to 6%. Afterpay is around 5%. Affirm is around 6%. All of them add about 30 cents a transaction. Rates move around depending on the deal and the volume. Big merchants negotiate down, but that's the neighborhood. Now compare that to an ordinary credit card. Card processing typically costs a merchant somewhere around 2 to 3%. So the store is paying 2, 3, sometimes 4 times more just to let you pay in 4. Sit with that. Retail runs on thin margins. Grocery margins are famously brutal, low single digits, and these stores are volunteering to hand over 5 or 6% of the sale. Nobody does that out of kindness. They are buying something. It's worth working out what. Here's what they're buying. You spending more. That's the whole product. And this is the part where I have to be honest with you about numbers, because this is where most videos would quietly lie to you. If you look up what buy now, pay later does to sales, you'll find enormous figures. Affirm says merchants see average order value jump 87%. Afterpay claims 20 to 40. Klarna claims a 30% lift in conversion. Ignore all of it. Those are the company's own marketing materials. They are selling a service, and those numbers are the sales pitch. A company's claim about its own product is not evidence. It's an advertisement with a decimal point. So what do we have that's more independent? Stripe, the payments company, not a buy now, pay later provider, ran a test across more than 150,000 checkout sessions. Where buy now, pay later was available, businesses saw up to a 14% increase in revenue. That came from 2 things: more people finishing the purchase and bigger orders. And a peer-reviewed study found that customers who adopt buy now, pay later spend about 6.4% more than customers using traditional payment methods. 14%, 6.4%, both a lot smaller than 87. But look at the direction. And then look at something better than any study. Look at what the merchants do. Because you don't actually have to trust anyone's research here. Merchants are paying 2 to 3 times the card rate out of their own margin on the same sales over and over, year after year. They would stop tomorrow if it didn't work. The merchant's behavior is the evidence. They've already run the experiment on you at scale, and they like the results enough to keep paying for it. So how does the trick work? Why does splitting a price make you spend more? It has a name, and it's been studied for nearly 30 years. It's called the pain of paying. The idea comes from a 1998 paper by Drazen Prelak and George Lowenstein called The Red and the Black, published in Marketing Science. Their argument was that paying isn't only a transaction, it's an experience, and it carries a cost that isn't financial. It stings a little, and that sting is doing a job. It's your brake pedal. Then in 2001, Prelak, this time with Duncan Semester at MNO, ran an experiment that's now famous. They auctioned off tickets to a Boston Celtics game. Half the bidders were told that if they won, they'd pay cash. The other half were told they'd pay by credit card. Same tickets, FIS, same game, same room. I can pan, same night. The credit card bidders bid nearly twice as much. Nothing changed about the value of those tickets. The only thing that changed was how much it hurt to hand over the money. That's the mechanism, and you can feel it on a sliding scale. Cash hurts most. You watch it physically leave your hand. A card hurts less. And 4 payments of $20 hurts least of all because you're no longer comparing $80 to your bank balance. You're comparing $20 to a sandwich. Your brain anchors to the first number it's handed. Buy now, pay later gets to pick that number. And this is the part I most want you to hear. This is not a willpower problem. You are not weak. This is a designed product, built by teams of people, tested against millions of transactions, and optimized specifically to make your brake pedal softer. Blaming yourself for it is like blaming yourself for losing a race against a car. Now let's go back to that 47%, the people paying late, because there's an assumption buried in that number, and the assumption is wrong. The assumption is that those people forgot, that they were careless. Think about how this actually plays out. You buy shoes in March, 4 payments. Concert tickets in April, 4 payments. Then groceries. Then a car repair. Each one is its own separate little loan with its own separate schedule, pulling out of your account on its own separate day. There's no statement. No single bill arrives once a month saying, "Here is everything you owe." Credit cards, for all their sins, do that one thing. Once a month, a number shows up. It might be an ugly number, but you see it. With buy now, pay later, that number doesn't exist anywhere, not in your banking app. And this is the part that genuinely surprised me, largely not in the credit system either. In June of 2025, FICO announced it was building buy now, pay later data into credit scores for the first time, with new models launching that autumn. And Klarna and Afterpay declined to hand over their pay in 4 data. Their stated reason is that the bureaus don't have real-time, accurate information on these loans, and reporting it could unfairly damage consumer scores. A firm reports its longer, interest-bearing loans, but its pay in 4 generally isn't reported either, though missed payments can still surface. So think about what that actually means. You could be carrying 6 of these at once, and there is no place, not your bank, not your credit report, where the total appears. That's why 47% keeps climbing. It isn't a memory problem. It's an architecture problem. You cannot miss a number nobody ever showed you. And when you do miss one, that's the second revenue line. Afterpay charges up to $8 per late payment, with total late fees on an order capped at 25% of it, or $68, whichever is lower. Klarna charges up to $7 per missed installment, capped at 25% of the order. Those caps are real, and they matter. This is not a payday loan. But notice what the fee is actually charging you for. It's charging you for the confusion the product created. Here's where people usually reach for history. So let's do it properly. none of this is new. In the 1920s, America worked out that if you let people pay monthly, they will buy things they can't otherwise afford. By 1925, roughly 3/4 of new cars in America were bought on installment plans. By 1929, Americans owed about $2.9 billion in consumer installment debt, and nearly half of that was cars. And the sales line, the actual line, was this: you can't afford it, but you can afford the payment. That's the same sentence. It's 100 years old. It's on your checkout page right now. But here's where I'm going to stop, and I want to be straight with you about why. The tempting move is to say, and then 1929 happened. Installment debt caused the crash. History is repeating. I'm not going to say that because it isn't settled. Economists have argued about the causes of the Great Depression for 90 years, and they still disagree. Some, like Barry Eichengreen, treat the credit boom as central to the story. Others, following Milton Friedman, put the weight on the Federal Reserve and monetary policy. There is no consensus, and anyone who tells you there is selling you something. So I'm not predicting anything. I'm pointing at one narrow thing: the sentence. You can't afford it, but you can afford the payment. That sentence works. It worked in 1925, and it works in 2026. It is the most reliable machine in consumer finance, and it has never needed an upgrade. Which brings us back to the groceries. Because now you can see why that number is different from all the others. Financing a sofa has a logic to it. You pay for it over 2 years, and you sit on it for 10. The thing outlives the debt. That's a trade, and it can be a reasonable one. Groceries don't work like that. You will have eaten the food before the 4th payment clears. The debt outlives the thing. And that's the line between a payment tool and a signal. When someone finances a sofa, they're managing timing. When someone finances dinner, they're borrowing from next week's version of themselves. And next week's version of them earns exactly the same amount of money. That's the whole thing. That's why 29% and 47% are the same fact wearing different clothes. When the debt outlives the thing you bought, you haven't solved the shortfall. You've moved it forward and made it slightly bigger. So what do you do with this? I'm not going to tell you never to use it. I don't know your life. For a lot of people, 54% according to that survey, this is the thing holding the month together, and me disapproving from inside a video doesn't pay anybody's grocery bill. What I'll leave you with is smaller than advice and more useful. This product's entire power comes from one trick. It shows you 20 when the price is 80. Everything else, the merchant fees, the late fees, the missing statement, the data nobody reports, is built on top of that one trick. So take the trick back. When you see 4 payments of 20, say the real number out loud in your head, 80. Then add it to what's already running on the other ones. That total, the one nobody will ever show you, the one that doesn't exist on any screen, is the only number that was ever real. Buy now, pay later isn't lying to you. It's doing something far more effective than lying. It's letting you not notice. Noticing is free, and it's the only part of this whole system they can't charge you for.